My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Do you want to make friends? I'm just trying to make a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. It's a jailbreak! That's how I felt about today's run. Dow advancing 146 points, S&P climbing 0.69%, NASDAQ gaining 0.83%. This kind of rally is unlike anything we've seen in ages because it was based this time on almost everything but tech. It was a pretty glorious advance. Bye! For weeks, I've been telling you just to own stocks, right? Because you can't wait for the all-clear jailbreak that happened today. You can't fight the positive tape. At the same time, you know the rally's no longer early when it broadens out like this, especially in an overbought market, and we are now officially in one. So I don't want to get all bulled up this late in the move. And yeah, we are late in this particular move, and you know I'm long-term bull. The big money's being made right now. But it's also being made on the order of sacrifice tech because there isn't enough cash to go around to have this broad in advance without something being sold, and it might be your stocks. Let me explain this moment. Because these days, well, they're like no other. These days are often when the most money can be made, something I'll be discussing tomorrow at our monthly CNBC Investing Club call. But first, let me give you the setup. This morning we came in and we got a benign consumer price index number. It was soft and sweet with just a handful of too hot entries. That's okay. Showing that the Fed continues to win its battle against inflation, as I have predicted endlessly on this show, because I told you that Jay Powell is a winner. Even though we don't know the results of tomorrow's meeting, it's obvious to me that there's a nice trajectory here that could produce the kind of soft landing we all want. A gentle touchdown without much awareness. Then you go off the jetway, boom. What a great trip. Now, the recent run is quite unexpected because everyone's terrified of what's known as the yield curve. Oh, I think it's a tiresome concept by now, but when longer-term rates, out, say, 20 years, are equal to or much lower than short-term rates as they are now, that's supposed to signal that we're going to have a recession no matter what. Long rates typically don't go below short rates unless people really feel awful about the future. So call it a hard landing, what everybody's looking for, a hard landing. The whole bond market is still betting that we'll have a recession, a bad one, and the Fed will be cutting rates furiously by the end of the year. That's fanciful to me, but there's no denying that is the betting favorite. Ever since the bottom in October, I've been telling you this whole rally is predicated on the idea that even if we have a hard landing, the mega-cap tech stocks will do just fine. Bye.
House of pleasure.
They've got tremendous balance sheets. And their products aren't all that economically sensitive. They'll do fine. You know what? I don't call them nation states for nothing. They're nation states because they're separate from the U.S. economy. But once we get to a point where it looks like the Fed really doesn't need to throw us into a recession, then the money comes out of tech and goes to the rest of the market. And that's what happened today. The money also comes out of bonds, and they were for sale all day. Now, does it make any sense on a day when inflation looks like it's under control, or at least more under control, that there's money coming out of the bond market? Shouldn't interest rates be going down? Well, look, in a normal market, yes. But you have so many people betting on a recession that it's beginning to look like they all have to switch and switch at once. That leaves bonds down, rates higher, and stocks higher still. I've railed against those who believe that the Fed will be cutting interest rates by the end of the year. I think they're so wrong that they'll roil the market when they unwind their positions, which is what they started to do today. But that's basically what we saw. That's what that Treasury sell-off told me. People also streamed out of those 1- and 2-year treasuries that were so loved. They're feeling the pain of not being in the stock market, too. See, they thought they were so smart picking up that 5% for nothing. Turns out it wasn't nothing. It was 5% at the cost of sitting out of one of the greatest stock market rallies I have ever seen. And that's why we had today's bullish jailbreak. Now, traditionally, this is the part of the rally that I actually don't care that much for. We've had weeks upon weeks upon weeks of strength. That meant nothing to so many of these supposed experts. It was led by a small group of large-cap tech stocks. So what? These naysayers are mostly bears who missed on the move, and they need to come up with any reason to justify why they aren't in, why they weren't wrong. In reality, you know what they are? I've been thinking and thinking and thinking. Losers. And I just use that word because they're losers. This is a business of winning and losing. You win when your stocks go higher and you make money, okay? You lose when your stocks go lower and you lose money. Hard? Let me further analogize. Let's say the NFL. Let's say we're in that. That's true gold standard business, not football business. In NFL terms, this market's been winning for months. But they were ugly wins. Close game wins. Wins that because they had fewer penalties, fewer unforced errors. Sure, the winner spotted the loser 5% at the beginning of every single contest, but they got nothing for it because a W is a W. Today, we saw the flaw in the argument of trying to get an L and still make money, because when we got a softer inflation number, money managers know they need to move fast through the rest of the market. The non-techs, whatever's still not up, they need to start covering their short positions at Carvana, the Upstart, the SoFi, buy the big industrials where there aren't a lot of shares outstanding. So the next thing you know, what happens when you try to buy stocks where there's not a lot of shares outstanding? You pay up 19 points for United Rentals, up 11 points for Deere. You pay up 7 points for Caterpillar. You pay up almost 6 points for Nucor, the steel company. Because you were waiting for the all clear. You're now chasing these stocks that have already roared. Carvana, Upstart, GameStop. They're not suddenly great. It's the shorts throwing in the towel. But suddenly we have money streaming out of tech because people have big gains there, and they want to move them into these newly enticing cyclicals, the industrials. You have money flowing from the bond market because there may be no recession, and the opportunity cost of collecting 5% interest, well, to do nothing, seems a lot higher. Ugly wins work. But if you want to come in right now when we're overbought, when we've already had such a huge move, to me that makes you vulnerable. I don't think you make all that much money coming in here. At this point, you have to wait because the Johnny-come-latelys are not destined for big gains. They never are. The relatively easy money in this rally has been made. For instance, Caterpillar. Where was it on May 31st? How about $206, okay? Oh, everyone told me that Caterpillar, severe recession. You got to stay away from Cat no matter what. Now, it's 13 days later, okay? It's 245. And suddenly, I didn't like it at 206, but at 245, I love it. Maybe I'm crazy, but I liked it a lot more when it was $40 cheaper. Look, I like a ton of stocks. I think you can find good buys in many sectors. I can see why people even wanted to buy the banks. If we're going to have a soft landing, you do want Morgan Stanley. You do like JP Morgan. There's nothing wrong with Wells Fargo. It's terrific. I can understand why people want to buy the beaten down retailers. I mean, Target's pretty low, don't you think? But, man, if you think you can come in at these levels and make a great deal of money, history says you'll be disappointed. Sure, maybe when the Fed meets tomorrow, they'll sound an all clear, right, that the strategists keep hoping for. Hey, you know what? Maybe Jay Powell says, it's time to buy Disney. Or maybe he tells you to swap out NVIDIA and buy some Intel. Crazier things have happened, although those seem unlikely. However, I think you're much better off waiting a bit now for the S&P 500 oscillator from Market Edge to come down a little. It's in overbought territory. Or put it another way, the big-time strategists are finally beginning to warm up to this market. They'll be all over the market tomorrow to tell you to buy. They just need to see all 500 stocks in the S&P 500 to move up, and then they'll tell you to pounce. Maybe they need all 600 stocks in the S&P 500 to move up before they'll tell you to bounce. I'm simply saying the risk-reward has shifted. The sideline money wants in because they didn't count the sloppy wins we've had for months. The bottom line, when the standings are posted, those who came in today are truly the people who believe they didn't miss Caterpillar, they didn't miss Apple, they didn't miss Microsoft, they didn't miss Oracle, they didn't even miss NVIDIA, my dog. And you know what? They did. They are late to the party here. Yet somehow they've convinced themselves that they're early. They're the ones who'll be wearing the lampshades on their heads, passing out on the couch. Me? I hate being the last to party. Cal in Illinois. Cal.
Oh, hello, Jim.
Cal, how are you?
Good, good. Been watching you forever on CNBC.
I've been on forever. Yeah, before they even had TV, I was doing this show. Incredible.
Right.
I was on radio.
Well,
What's up?
Yeah, in 2005, you recommended buying Google with very strong words like, you have to buy it, you have to buy it. So
I put it on my fingers. I wore it on my head. I did everything I could to get in. They all laughed. They all laughed. It was like Carrie with John Travolta. Go ahead. Go ahead. Oh, I didn't cut off Carol, did I? I still like Alphabet. I mean, what? The Chapel Trust owns it. I like it. We'll talk about tomorrow.
What?
Oh. Nasty. How about Hunter in Virginia, please? Hunter.
Booyah, Jim. It's a great day in Cramerica. First-time caller here. Watched the show with my future in-laws, George and Elaine. Have been watching you since 2005. As an eBay shareholder with an average share price of $54, would you continue with dollar-cost averaging given their long-term growth prospects?
No. eBay doesn't have the kind of growth that I want. Nor does I'm going to give you a twofer. I don't like PayPal either. No growth means no buy. Money losers mean no buy. Let's go to Barbara, New Jersey, please. Barbara. 32 seconds.
Hey, Jim. It's Barbara from New Jersey. I've been watching your show for years. My question pertains to Exxon stock. I have a sizable investment in Exxon stock, and I see there's really been no movement, even with the tightening in the oil You know,
Right.
so I'm wondering, should I hold or sell?
No, Exxon's just a good, solid company. You want to buy some even if it comes in. Now, I'm not a huge fan of the oils here, but I do think that down lower, they're going to be fine. I see the government's actually kind of doing a little buying. I don't want to sell the oils here. That doesn't make sense. All right, a lot of people came in today, and I think that they're late to the party. I like to be earlier to the party. I think it's more fun. If you think you can come at these levels and make a great deal of money, good for you. History says you'll be disappointed, but that's okay. I'm everybody tonight. There's a big tasty IPO in the works. I'm taking a closer look at Kava ahead of the public listing to see if the investors should take a bite of the Mediterranean food chain. Dylan's got some footage. But first, the IPO market has some seemingly stalled the last 18 months. I'm seeing where Kava fits in and what it could mean for the IPO market as a whole. And just ahead, key Fed decision. Could the market continue to have legs? I'm going off the charts with the S&P to see what's going to happen. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.